Okay, I guess we'll get it started. We do have a full agenda today that we're trying to cover in 30 minutes. If it goes a little long, I do apologize. Again, I'm Jim Campanella, sales manager of Your Mortgage Guys at Cross Country Mortgage. And we're going to be talking about debunking your credit score. So let's first let's do some basic logistics. You should have the ability to pose questions and answers. Please do so. We will take the questions at the end simply because this is going to be a full topic. So, you know, we'll take the questions at the end, but please, if you have any questions, post them on the site. Okay, here we go. All right, debunking your credit score. I also apologize for the glare I can see in my glasses, but the lighting doesn't work well. All right. First off, a little bit about myself. I will give you your disclosure here. I am not a credit counselor. I am not here to sell you a product. I am not here to promote any certain credit rescoring system or how to repair your credit. I've been doing mortgages literally since high school. This is the only job other than waiting for my singing career to take off. This is the only job I've ever done. I have held positions from loan officer to processor to underwriter to manager, as well as owning my own mortgage firm. So I can certainly present you information about how your credit affects your ability to get a mortgage. But I am not here to necessarily sell you on any credit rescoring product or anything like that. So, going on. All right, credit scoring and knowing your credit. Obviously, credit is one of the most important things you can know, especially when it comes to obtaining financing. So it's important to have an understanding of what goes into your credit score. For those of you who have worked with me in the past, you've probably heard me say, knowledge is power. I really feel that way. So the more knowledge you have, the better control you have over your situation. Okay, so understanding credit scores. What is a credit score? Prior to 1989, we had no credit scores. It was underwriting was more of an art, where the underwriters would review your credit, look at the strengths and weaknesses, and make a credit decision. Well, that leaves a lot open to lack of consistency. So in 1989, the credit score was born. Credit score was born by a company. It's a for-profit company called Fair Isaac. Also known, most people know it as FICO. It's the top method. 90% or more of all firms use FICO. So that's who everybody's based on. Certainly in the mortgage industry, we use FICO, Fair Isaac. The interesting thing that most people don't understand is that FICO is a for-profit company. I keep emphasizing that so you understand the next statement. They have 53 scoring models. They've sold TransUnion 21 scoring models, Equifax 16, and Experian 16. So when you look at your personal credit score, it's going to differ than what we pull up, which is going to differ than what an auto loan pulls up, which is going to differ than what an insurance company pulls up. And the bottom line really is why we have all these different scores is so that they can sell more scores and make more money. A mortgage score is weighted differently. We calculate it differently than what an auto company would or a credit card company would or what you see on your personal finance. The FICO scores range from 300 to 850, 850 being perfect score, 300 being not a good score. The higher the score, the better your credit. For you to get information, you're entitled to it by law. You can get your credit report every 12 months, so annually, for free from annualcreditreport.com. Again, the key word is annualcreditreport.com. There are other services like freecreditreport.com and other things like that that are not ran by the government. Annualcreditreport.com gives you the ability to pull your credit every year for free. It does not give you the ability to get your credit score for free. It gives you the option of buying your credit score, but you get your credit report annually. A lot of people choose, a certain day a year to, just set that day aside, and every year do it on that particular day. May 1st, every May 1st, pull up your credit. The other company I mentioned here is Credit Karma. There's a lot of companies now out there besides Credit Karma. I happen to use Credit Karma and have for the last couple of years. I don't know how they offer it for free, but they do. Again, I'm not promoting Credit Karma. There's many of them that do it, but Credit Karma will give you your consumer report or your consumer score for free. They give you 2 out of the 3 scores. There's 3 credit bureaus in the country. There's 4 credit bureaus in the country, but 3 control everything. There's a 4th one trying to get in. So there's 3 credit reports in the credit bureaus in the country. 2 of the 3 share that information with Credit Karma. But again, you can get it off your credit-wise, off your credit cards, and there's other services to pull it for free. Should you need to dispute any information or want to contact them direct, these are the 3 major bureaus: TransUnion, Experian, and Equifax, and their contact information, at least based on the information I have of how to contact them. For the most current information, of course, you could go to annualcreditreport.com and they'll have their contact information as well. But the 3 bureaus you want to work with would be TransUnion, Experian, and Equifax. Should you have a need to get assistance, the government does offer you assistance, some of it free, at HUD.gov. So should you, and this is just an example of their page, but should you run into a situation where you're not getting any resolution that you're trying to get, you can go HUD.gov. Okay, let's get into the meat of it. How your credit score is determined. Now, again, I'm talking about the scores that we use. Others industries might have a slight variance to the percentages and so forth, but there's 5 factors that go into how we get our score. And they are your payment history, the amount you owe, your credit history, meaning length of time of credit, new credit, which would, a lot of people would consider as your inquiries, and your credit types being installment, mortgage, revolving, which is credit cards, so on and so forth. Okay? The breakdown, and this becomes where it needs to be, where you can have a better understanding of your credit, is 35% of the score is computed from your payment history. 30% is what you owe, 15, 10, and 10. So let's talk about this, because this is where you can also work on ways to quickly, and not so quickly, improve your credit. 35% of your credit score is based on your payment history. So 1/3 of everything is based on that history. Let's say your score is not where you want it to be. For a quick fix, this is not the area you're going to be able to work with, because the quick fix would be pay your bills on time for a long period of time, and that'll improve your score. So if you had lates in the past, you can fight them and dispute them to get rid of them. Otherwise, the only way to really improve your score this way is through length of time of paying your bills on time. 30% of your score, so this represents, these 2 factors represent 65% of your score. 30% of score is on your amount owed. And what that is your available credit, how much your credit cards are offering you to what you owe. So this is somewhere you can do a quick fix, because I'm just going to use a $1,000 credit card as an example. If you have a credit card with a high limit of $1,000 and you owe $900, your score is being adversely affected because of the fact that you owe a high balance compared to your available credit. So if you needed a quick fix to get your score up, pay down your balance. That's something you can do instantly. Whereas you'd have to have longer payment plan to change your payment history. The factors that go into the balance owed is twofold. The credit scoring system looks at per line item and also the cumulative total. So if you have a Visa card that has a $500 available credit and you owe $450, that's going to adversely affect you because you're near your limit. But if you also have a Discover card that has a $30,000 limit and you only owe $1,000, you're not going to be as adversely affected because the cumulative total is that you're not a user of credit. You just happen to be using that one credit card a lot, or smaller balance. So you've got to look at the individual line items as well as the total package. Okay. A lot of people will ask, where's the sweet spot for credit? The common belief or accepted belief is 30%. So if you're below 30%, you're in your best position, and that's the common belief. So if you have $1,000 available credit, you'll less than $300, you're in a good position, and you are in a good position. The only reason I put an asterisk on that is I'm actually working with a client right now, and we've been running it through some credit scoring models, and we found that at less than 10%, his score actually goes up again. So in the perfect scenario, having less than 10%, I guess, is really the new norm. I don't know if that's realistic. So everyone uses the 30%. So again, on $1,000, if you owe less than $300, you're in a good position. But again, I found that we can do a little better than that with the 10%. All right, so let's continue on. Credit history. Credit history is your length of credit. Most people, I think, are getting this now, but for a while, people believed that when you pay off your credit, you should close your account. That actually hurts you, because if it was a credit card or something that you had for 10 years and you close it, now all of a sudden that history is gone. So if your next credit card is only a year old, you've got no history. So paying off your credit card is always a good thing. Closing them, bad thing. Now again, it's a small percentage. It's only 15% of your credit, but you want to keep your credit open and available to you. Credit types, we'll go back to the inquiries in a moment, but credit types is simply mortgages, installment debt, credit cards, so on and so forth. It's 10% of your score. If you have no credit, that'll be, that adversely affects you. If you have too much credit types, like if you have, 35 credit cards, that's going to adversely affect you. The perfect blend would be, obviously a mortgage, because that's what we do. Installment debt, which would be a car loan, and 3-4 credit cards. That would probably give you your best presentation. Again, it's only 10% of your score, so it's not a big factor. And if you're trying to improve your score, it's not going to make a big difference there. The area to improve your score, again, quickly, is by paying down your credit. Okay, let's talk a little bit about inquiries, because that's always a topic everybody likes to talk about. There's two types of inquiries. There's the soft pull or soft, inquiry, and the hard pull or hard inquiry. The big difference, to explain it, is a soft pull is connected to no specific application. It's more like for a pre-approval. So when you look at your credit, you're not applying for anything. That's a soft pull. It doesn't count against you. When you get a credit card application in the mail saying, hey, you're pre-approved, that's a soft pull. They haven't really offered you anything. They just know that based off the credit that they pulled, you fit their, the type of customer they're looking for. Soft pulls do not show up on your credit, and it does not count against you. Soft pulls, they do not need your permission to pull either. So if you get any, notice from an insurance company saying, hey, we'd like to offer you insurance, you might sit there and say, well, I never gave them the authority to do that. But if it's a soft pull, they don't need your written authority to do that. A hard pull is a genuine inquiry tied to an actual loan request. I have heard from customers from time to time that they say that, can we do a soft pull on their credit? Well, the answer is no, because you're doing a loan request. No mortgage company can. So if a loan officer tells you that, they can do a soft pull, they're lying. because again, a hard pull is tied to a mortgage or to a loan request. In mortgage companies do loan requests, so our credit pulls count as a hard pull. Auto loan, same thing. It's a hard pull because it's tied to a specific vehicle you want to buy. Now, if you get a pre-approval from Credit One Bank saying, come in for an auto loan, that could have been a soft pull because of the fact that you fit their model. But a hard pull or a hard credit inquiry, mortgage companies are all hard pulls. Okay. So when it comes to understand, again, this is a small factor when it comes to your score. It's only 10% of your score. I'm not suggesting that it's not an important 10%, but it is only 10% of your score. So a lot of our customers, come back and, watch, I don't want to have my credit pulled. Well, you need your credit pulled, number one. And number two, it doesn't dramatically affect your score. Some interesting things while I was preparing for this webinar, some things I didn't even understand or know, so and hopefully this shares some information with you guys, is FICO, according to their website, does not count a credit pull against you for 30 days. I know that's hard to believe. I'm not sure if it's true. It is at their website. Many people will say, hey, Jim, you pulled my credit and my score dropped 5 points. I believe them, but according to FICO, they do not adversely affect your score for 30 days. And the reason for that is to give you 30 days to turn that inquiry into a transaction. So whether it be an installment debt, an auto loan or a mortgage, they're saying you got a 30-day window before we're going to count that inquiry against you. Take it for what you will. It's from their website, but I know a lot of people that'll say my credit, was affected by your inquiry. Things to be aware of: multiple inquiries of the same type. So, like, use as an example, you're looking to buy a car. Multiple inquiries of the same type count as one pull. So, I have one right now. A client bought a car February and had 8 credit pulls from different car companies and auto, financing companies. That counts as one, and that's pretty accurate. I know people will say, "Oh no, it really affected my score." That probably wasn't what affected your score, because I've seen it enough times to know that if it's an inquiry that ties directly to buying a car, it affects you one time. So you can go to multiple dealers, you can shop it around, and it's one inquiry. Previous models of the scoring system counted as one inquiry during a 14-day period. So they gave you 2 weeks to find a car. The newer scoring models, and again, there's 53 of them, so you don't know which one necessarily you're going to be affected by. But the newer scoring models actually gives you 45 days. So, if you don't buy a car that weekend, you don't have to worry. You've got 45 days to buy that car. We, of course, in the mortgage industry, like to tell you, you don't want to keep having mortgage inquiries because, it affects your score. We say that simply so you don't shop us, is the truth, because it doesn't affect your score. It's one inquiry. So you shouldn't shop us, by the way. But if you did, it would only be one inquiry. Another scoring model, the Vantage model, which is one of the 53, uses it as a 2-week rolling score calculation. So it continually is adjusting based on your inquiries, which is different than the other way. So it's, there's 53 scoring models. They all vary slightly. The point I wanted to really emphasize here is certainly it's important to watch your credit. Certainly it's important to mind what your score is, but fretting over the inquiries is less important than worrying about how much you owe or your payment history, because that's 65% of it. Now, if you're looking to get to a 640 score and you're at 639 or 641, can an inquiry make a difference? Yeah, you've got to be a little more cautious of that. but I want to emphasize, you focus on, where you can really make a difference in your score, and where you can make a difference in your score is by paying your bills on time and working on those balances. I was at FICO's webpage, and they gave us a couple specific examples where a client paid down his credit, a sum of money, and his points went up 78 points overnight. So that's simply because he owed less money. So, if you're on, I know I've got some customers on here, some leads on here, and actually some realtors are on here. If you're talking to your customers, or, you're talking amongst you and your spouse, focus on what you can control, and what you can control is what you owe. Okay, going on. And again, any questions, certainly put them in the questions and answers, because we'll respond to those as we get to the end. It's important to understand that certain events affect whether or not you can buy a house. Obviously, this is talking about debunking your credit score, but I'm assuming those of you who've joined me are here because you're thinking or are buying a house. So I'd share with you that information. If you were on the last webinar, I've shared the slide previously also, but it's important to note, especially since we're post-recession. We went through the Great Recession in 2008, 9, 10. A lot of people, had foreclosures or bankruptcies. They may or may not know that, it's amazing. 11 years have passed since 2008. You may now be eligible to buy a house. Some people are, concerned that they may not be. But FHA only requires 2 years from a discharge from a bankruptcy. Conventional financing, Fannie and Freddie, requires 4. From a foreclosure, FHA is 3 years, and it is 7 years for Fannie and Freddie. There are other programs called non-prime programs that have different rules. They're risk-based, which means they'll cost you more. Their interest rates will be higher, their costs will be higher, but they'll take more risk. One of our future webinars will be talking about non-prime loans, because there's a lot of amazing products out there now that are not like the subprime loans that got us in trouble. These are loans that make sense and still protect the investor, the lender, because the down payments are there. Where we got ourselves in trouble, and not that I want to go off on that, but we were doing subprime loans with no money down at 580 credit scores. They were risky loans. These, we can do a 580 credit score, but you're going to put 25% down. If you put 25% down, you're probably not going to walk from your house. So it's a different animal. In any case, these are the waiting periods you need for getting financing. This slide was previous also. It is required by my processing staff that I share this with you every webinar, so I shall. And now that you understand your credit scores a little better, or hopefully you understand them a little better and what goes into them, you'll understand some of these the do not lists. Again, if you're a home buyer or if you're a realtor, you can tell your home buyers, do not make any large purchases with your credit cards. The reason for that is really now twofold that you can understand. Number one, if you make a large purchase and it changes your credit score because now your available credit's less, that could affect your ability to get the loan. And number two, making a large purchase with a credit card or obtaining new credit cards could change the score from the standpoint of your debt ratio. So you've got to be careful not to make any large purchases. You do not want to be buying furniture until after you're in the house. Do not open any new credit cards or installment loans. Again, it affects your debt ratio as well as possibly your score through inquiries and the amount of debt you have. Because again, we're always watching what's available to you, the utilization of your credit, what's available to you to what you actually owe. Do not make any large deposits that you cannot source. Again, we're not suggesting by any means that you can't deposit money in your account. You certainly can, just make sure you can document where it came from. We will ask what these large deposits are from. I don't plan on a webinar on a whole discussion of that, but there's many reasons why, from an underwriting standpoint, including federal law, that we need to know where your large deposits are coming from. So don't make any large deposits. Certainly you don't want to make any cash deposits. And finally, when we calculate your income, you got to have an income. So don't quit your job. This way now we're in compliance with my processing staff by reminding everybody that these are important factors. Again, here's my contact information. Should you have any questions, again, if you wish, put it in the questions and answers. If not, you can contact me, via the phone or, email on any questions you might have. Legal disclaimer, of course, is the required by federal law and cross country to share that, yada, yada, yada. Future webinars that are coming up, we'll be talking about the next one in a second here, but I'm actually envisioning a situation, I don't know that I will do this by any means, but earlier, before we started, I had mentioned that, people hosting webinars, will think that the classroom is a virtual classroom or a virtual auditorium. I really like to think of it as a virtual cigar lounge where you guys can sit back, relax, and and we can have a conversation that way. One of my other ideas is actually to do something like real estate and cigars as a podcast, and have people like appraisers and termite inspectors and realtors and attorneys just sitting around enjoying themselves and discussing the various aspects of the industry and in the home buying process. I don't know that it'll ever come to fruition, but that was my thought. Okay, next webinar is going to be the mystery of the debt ratio. It'll be on Wednesday, May 15th at 7:30. We're going to keep the time the same, but I'll shift it back to Wednesday. Last one was Wednesday also. So it'll be Wednesday, 7:30 on May 15th. Certainly, as of tomorrow, you'll be able to register. Mystery of the debt ratio is basically going to cover the math of what we do. We'll help you understand that if you make $20,000 a year as your income, that you're probably not going to qualify for a $400,000 house. And we'll explain why through the math of what a debt ratio is and how we compute that, and shortcuts for yourself on if you're out looking for a house and you run across one, and is it affordable? We'll help you through that, through the mystery of the debt ratio. So hopefully you'll decide to join us for the next webinar. And let's see here what we've got. There we go. Nope, wrong button. There we go. There we are. All right, let's see how we're doing. If we have any, if you have any questions, certainly feel free to post them, and we'll see what we've got here. Leah from Lansing, why is there not just one score? Excellent question. It'd be great if there was. I honestly believe that probably if you pulled up your consumer score, you probably have more than one consumer score even. My only answer on why there is not just one credit score is because Fair Isaac, FICO is a corporation that makes money. And the more scoring methods they have and the more ways they can sell it, the more they can make, which is a shame. Maybe one day we'll have one score. Anna in Springfield, it's nice to see somebody from down south. How long of a history does your credit score use to calculate? Excellent question, actually. Obviously, there's different factors that go into it because the length of time of your credit's the length of time of your credit. But what inquiries stay on your credit for about 2 years. It's not an exact science. I don't know why it isn't. It's not exactly 2 years. It's about 2 years. It does not, the longer from the inquiry, the less it affects your score. So that's sort of phases out. The history, your payment history, is affected for a rolling 24 months. So if you had credit issues in your past, you'll find your score each month going higher and higher, and that aspect of it. For during a 24-month period. So if you had credit issues 28 months ago, it's not affecting your score. The credit system is looking at your last 24-month history. Marco over in McChesney, what can I do if I find something wrong with my credit report? If there's something wrong with your credit report, you can dispute it. Again, I suggest using annualcreditreport.com. It's a very easy website to use. You don't have to use that website to dispute your credit. You can contact the 3 bureaus yourself. But all 3 bureaus are connected to that website, so certainly feel free to contact them via the annualcreditreport.com. And you can dispute it. There's a whole process that you go through to do that. The topic of credit is a big topic, and it's hard to cover everything in 30 minutes. So I am planning, just so you're aware, a second credit webinar in the future. Again, the next one is going to be debunking your debt ratio, or not debunking, but the mystery of your debt ratio. But we'll probably have another one in the future, and I may even bring in somebody who can talk more about it. What I hope, and again, I'm not opposed to anybody paying for credit repair. That's not. There's some very good credit repair companies out there. There's some that are not. There's some that are out there just to collect your money. I'm not here to judge credit repair companies. What I am here to say is that there's some very simple things you can do to make your credit better. And that's by paying down your balances or, having a good payment history. You can go on to your, annualcreditreport.com yourself, review your credit, find the things that are, able to be disputed and dispute it yourself. You don't need a company doing that for you. Now, again, I'm not suggesting that you should do it yourself. If you feel comfortable and want to pay a company to do that, go right ahead. But these are things you can do yourself. They don't work mysteries. Again, knowledge is power. If you just take the time yourself, you can do a lot of repairing and credit improvement yourself. All right, also going on. What score do I need to get a mortgage? From Chad from Chicago. Excellent question. Sorry, I did not address that. Credit, I just want to reiterate this. Credit score is one aspect of getting a mortgage. Just because you have a certain credit score does not mean you're going to get a mortgage. It's a very good indicator that you will, but there's other factors that go into the whole underwriting process. Debt ratio being one of them that we're going to be talking about. In general, if you're a veteran, VA loans have a $500 minimum credit score. A lot of lenders will what we call overlay their own guidelines on top. A lot of banks are at 620 for VA, but technically it's 500 for a VA loan. FHA has a 580 minimum credit score, and again, a lot of banks will throw on their own overlay at 620. 620 is where most lenders like to be. 620 to 640 is where most lenders like to be. But FHA actually is a 580 credit score. USDA is a 640 credit score. It's got higher guidelines, but again, it's no money down for if you're buying out in agricultural lands. And conventional is a 620 credit score. So if you're at 619, you're going to be going FHA, unless you can get that score up to 620. Going into quickly the pricing differentials, FHA is just pretty much a flat rate. It is what it is. Whereas conventional loans are risk-based price, so the higher your credit score, the better interest rate you're going to get. So if you're above, the world considers 720 to 740 the perfect scenario, the perfect score. If you're above 720 to 740, you're going to get the best rate you can obtain. And then it goes down, 680, 640, so on and so forth. For down payment assistance programs such as IDA and anything else that's out there, 640 is the minimum score. So that's a great question, Chad, to ask where you want to be. And let's see what else we got. Well, that looks like that covers everything. Again, I'm Jim Campanella, sales manager of Cross Country Mortgage, and feel free to contact me if you have any other questions. Otherwise, I hope to see you at our next webinar. Thank you for joining me.